Let's be real. There's a lot of doubters about the wheel strategy, about how just straight up stock ownership is better. But today I'm going to open up your eyes and show you guys exactly why the wheel strategy is so powerful that it doesn't make sense to just buy and hold stocks. In the wheel strategy, you can do the same thing, but get much better returns. So I'm going to show you guys 2 live examples of trades that I'm actually in and stocks that I'm actually holding where I use the wheel strategy to sell cash secure puts to enter the trades. And I've been selling covered calls on them while I've been holding them. And in one of them, I'm up over 114% in 11 months. And the other one, I'm up almost 300% in a little over 3 years. Okay, 300% in over 3 years. So I'm going to show you guys both of those. And as always, nothing in this video is financial advice. It's all for information and educational purposes only. Let's get started. So get ready to take some notes. To begin with, what exactly is the wheel strategy? It is a way to basically enter positions, enter and buy stocks at a discount from the current trading price. And while you wait, you can collect premium as passive income. So let's go in an example. And the first one I'm going to show you is on Mara, because that's the trade that I'm currently holding. Those are the shares I'm currently holding where I'm up 114%. From the price I got assigned, the stock is only up like 50 cents. Okay. And yeah, I'll break it down in the video, so keep watching. So the way this wheel strategy works is, say Mara right now is trading at 1950. And you're like, you know what? I'd like to buy some shares of this. Trade options, you go into put, sell, and select an expiration date. I like to go out about 30 to 45 days. So November 21st is the monthly one, so it should have good volume, 35 days. So that fits the criteria of 30 to 45 days. And now I can select a price that I'm willing to buy Mara at. You have to make sure, and this is why it's called a cash secured put, each contract controls 100 shares. So you have to be able to have enough cash in your account to be able to buy 100 shares of the stock that you're doing this with. I'm just using Mara as an example. This can be done on any stock, okay? So this is, let's say I'm comfortable buying this company at $17 a share, which is $2.50 almost below what it's currently trading at, okay? And for that, I can collect $125 in premium. That's $1.25 per share that I'm getting paid just to wait and see if it dips to that price, I'll buy it. If not, I keep this $125 and I move on. I don't own shares, but I collect that income just for making a promise that if Mara, by November 21st, at expiration, if it is at $17 or below, I will purchase it at $17. So yeah, it could be at $16. You still have to buy it at $17 because that's a promise that you made. But guess what? If you're willing to buy 100 shares of Mara right now at 1947, if it's at 16, you've still taken that paper loss. It's not a realized loss because you haven't sold yet, right? But it's still that loss. So when people say, hey, you bought it at 17, but what if it's at 15 or 16 by the time? Yeah, and that's exactly what this is for. You're still buying it at a better price than it is today. And it's something that you might want to hold long term if that's your plan. And I only sell cash secured puts on companies that I don't mind holding long term. So that's the first part of the wheel strategy, is collecting premium while it gets to that price, and you collect premium until you own the shares. Then what happens if it dips and you end up getting assigned? That's when you move to part 2 of the strategy, selling covered calls. Because now if you were to get assigned 100 shares of Mara, say today, okay? Today's Friday. If you got assigned shares of Mara today at say $19 or $20, you can go back into trade Mara options, select an expiration date. And again, for this example, we'll just go out to November 21st again. Now you're going to sell a covered call. Sell, call. And now say you're comfortable, your cost is $20, for instance, and you're comfortable selling it at $22. So now you can sell a covered call. And while you're holding those shares, you can collect $1.70 per share. So for 100 shares, that's $170 that you're collecting while you're just holding. Again, passive income while you are waiting on that stock and while you're holding it anyway to get to a price you'd be willing to sell it at. And that's above your cost basis. So if by November 21st, Mara was to rise and it goes above $22, guess what? Number one, the shares get called away at $22. You bought them at $20, so you profit $2 per share on that, and you still get to keep $1.70 per share that you collected up front. So this is yours to keep no matter what happens. If Mara stays below $22, you can do it again next month, and again next month, and again next month. And that's how the wheel continues until the shares get called away at the price that you are willing to sell, okay? Because you're the one selecting the strike price. Now, you still have the shares. You have this additional income that you collected up front. This is where the example comes in. So here's my account. So this is where I started the wheel strategy with Mara back in December of 2024. Right now, it is October of 2025. So let's go back to December of 2024. And I started this December 3rd. So, all right, December 3rd is right here. This is where I started the strategy. And Mara was at $25. Okay, $25. At that point, I sold cash secured puts at the $22.50 price. And I did this with a ratio put spread instead of just cash secured puts, but this was the cash secured put part. Eventually, what happened was all of this stuff happened. I kept selling cash secured puts until I got assigned Mara 1,000 shares, 10 contracts, because each contract controls 100 shares. I did 10 contracts, so it was 1,000 shares at $19 a share, which cost me $19,000. That happened February 3rd of 2025. So until then, I was just collecting premium. So let's go to February of 2025. Let's see, what exact date was that? February 3rd. Okay. So when I go to February 3rd, this is where I got assigned. Mara was at 17 something and my strike price was $19. It was below my strike price. So I got assigned. I still had to pay $19 even though the stock was at $17.55 that day, right? In the 17s. What happened afterwards? Whenever I got assigned, I started selling covered calls. I kept doing it. Look at what happened to Mara, okay? It kept going down and then it just stayed flat. It went down. That's what it's been doing for the past year. Right now, Mara is at 1963. I was assigned 10 months ago at $19. But look at this. I kept selling covered calls along the way. Sell to open, buy to close, sell to open, buy to close. So I've been collecting premium for a very long time. And as you can see, the last one I did was today, October 17th, where I sold a $20 call and collected an additional $2,200 because that paid me $2.22 per share. Each contract, 100 shares. Times 10 contracts, 1,000 shares, $2,200, right? And I sold this for next month's expiration. If Mara is above $20 by that point, I'll be able to sell it at $20, right? Now, and if it's not, I keep collecting more premium each month. Now let's do some basic math. If I was to just hold Mara shares that I bought at $19 and I sell at $20, right? $20 minus $19, my profit would be $1 a share. I divide that by $19 because that's my cost basis, right? That's my cost at that point because I'm not selling covered calls or cash secure puts. I'm just buying and selling. Over the last 10 months, that's a 5% return. Okay? Not too bad. It's still growth, right? It's still a 5% return. Now, this is where I get to blow your mind, so get ready. Because I've been selling covered calls all the time and I've sold cash secure puts and collected premium in advance, my cost basis for 1,000 shares is $9,340 instead of the $19,000 because every time I collected the premium from selling covered calls on it for the last, 10, 11 months, that's what's been happening. So now let's do that same math again. If I have 1,000 shares, right? If they get called away at $20,000, my cost for those 1,000 shares now, because I've been collecting premium for so long while I've been holding the shares, my cost is now for those 1,000 shares, $9,340. That's a $10,000 profit, $10,660 profit on that. So when I divide that by 93.40, which is my cost basis, times 100, that's 114% return on my money instead of the 5% return I would have gotten if I just held on to the shares. Let that sink in. And this is where those calculations and the math comes in handy to prove that even when in a sideways market, stocks can go up, down, sideways, whatever it is, with the wheel strategy, I'm collecting income every step of the way, and as time goes on and I keep doing it and stay disciplined with it, I can get much better returns with the wheel strategy than just holding onto those shares, okay? This is one example, right? Great. 114% return in 10 to 11 months? That's ridiculous. And I'm still holding the same shares. I still have them. Let me show you another example where this is going to really kick into high gear. So in my other account, I did this with SoFi, okay? And I've been doing it on SoFi, right? It was February of 2022, February 7th. Let's go back. Okay. February 7th, 2022. Here we are. At that point, SoFi was at about $12, $11.91. I started selling the $10 cash secure puts. Things were going great. I was collecting premium. And then I got assigned in March. At that point, I was selling the $11 puts. I got assigned right here 1,000 shares because I did 10 contracts of that as well at $11 a share, which cost me $11,000. What did SoFi do after that? Yeah, it went sideways. It actually went down all the way to $4. I was assigned those at $11. Most people would be freaking out at that point. They bought something at $11 and then it drops down to $4, $4.50. But I wasn't worried because I wanted to hold it long term and I was selling covered calls on it while I was holding it. As you can see right here, I kept selling covered calls. I'm just selling covered calls. I'm just hanging on, selling covered calls. That's all I'm doing. Right now, SoFi is at 26.60. I still own those shares because I've been selling covered calls and I've been rolling them out as it's been going up because I want to hold them. So now I have my covered calls rolled out all the way to 2027 at the $25 strike price. So the price currently is actually above what my strike price is that I was willing to sell SoFi at. As you can see right here, $25 call, right? Now, if you had just bought SoFi at $11, that's still a great return, right? If it was 1,000 shares, 26.65 times 1,000, right? And my cost on that was $11,000, right? Because I got assigned at $11. So let me take out of that. So my profit would be $15,650 on $11,000. So 11,000 times 100. So now 142% return. Amazing. But because I've been selling covered calls on it this entire time, my cost basis is not $11,000 that I actually paid for the shares because I kept collecting premium. My cost basis is $6.34 per share. Let's do this again. $25,000 is how much I would sell them at because if they got called away, because that's the strike price that I've sold the calls at, minus 6,335, that's my cost. That is the profit divided by 6,335, which is my cost, times 100. Yeah. That is a 294% return, almost a 300% return just because I was selling covered calls along the way. No one's going to complain about 150% return, right? But 300% compared to 150%, that is huge. In 3 years, getting 150% return or a 300% return, you tell me what's better. This is why I like to break this down with numbers so it's a little bit easier to comprehend and understand. Because yeah, people can talk about selling covered calls and cash secure puts and the wheel strategy and all that stuff and be like, oh, you're missing out on all of this growth. I didn't miss out on any growth with SoFi. It actually went down a lot and then it shot up a lot. And I'm still taking advantage of that growth by rolling out the covered calls. You just have to know how to be able to do that stuff. So when you look at stuff like this, do you still think that, yeah, just owning and just buying the shares at the market price and then selling them at the market price, that's the best way to do this? For some, it may be. For me, I'd rather maximize my returns. I'd rather take a 300% return than a 150% return. On Mara, I'd rather take a 114% return compared to a 5% return. Makes a big difference. I hope that helped you guys kind of understand how the wheel strategy actually works and what's the math behind it that makes it more efficient than just buying and selling the shares of companies you actually want to own. And if you guys want my real-time trade alerts where I'm posting all the trades that I'm actually making, if you want my checklist for the wheel strategy for selling covered calls and for cash secure puts, if you want all of my checklists and a community chat where you can ask me all of these questions that you guys have, and it's a great community that I've built. We've got thousands of members in there. Just click on the link in the description below, check it out, and I will see you on the next one.